Wall Street agrees on one thing. Artificial intelligence is reshaping the global economy. But there's one question the market hasn't fully answered. Who will ultimately capture the economic value of that transformation? Everyone talks about NVIDIA. Some investors are now talking about Broadcom. But there's another company quietly enabling the infrastructure behind the AI revolution. Marvell Technology. Today, we're not asking whether Marvell is a great company. That's already reflected in the narrative. The real question is far more important. Has the market already priced in Marvell's future? Because in investing, the quality of a business and the quality of an investment are rarely the same. And that distinction is where every great equity research begins. Mispricing isn't about finding a great company. It's about identifying the gap between price and reality. To determine whether Marvell is truly mispriced, we need to answer three questions. What expectations are already reflected in today's stock price? Can the business fundamentally support those expectations? And most importantly, where might the market be wrong? Only after answering those questions can we decide whether Marvell is an opportunity or simply another great company trading at a great price. Every stock price is a reflection of expectations. Not today's earnings. Not last quarter's results. But the market's expectations about the future. Those expectations are built on assumptions. Assumptions about growth, profitability, competition, execution, and the durability of demand. When investors buy a stock, they're not simply buying the business. They're buying those assumptions. So before we evaluate Marvell, we first need to understand exactly what the market is already pricing in. The market's optimism doesn't exist in isolation. It's built on a simple narrative. Artificial intelligence is driving the largest infrastructure investment cycle in decades. Cloud providers are committing unprecedented levels of capital. AI models are becoming larger. Data centers are becoming more complex. And every new generation of AI requires faster, more efficient connectivity. Within that narrative, Marvell is positioned as one of the key beneficiaries. Not because it builds the most powerful AI chips, but because it provides the infrastructure that allows those systems to scale. That is the story the market believes. The next question is whether the numbers support it. The narrative explains why investors are optimistic. The consensus tells us how optimistic they really are. Analysts are projecting sustained revenue growth, expanding profitability, and continued earnings acceleration over the coming years. Underlying those forecasts is a common assumption: that AI infrastructure spending will remain resilient, that hyperscale customers will continue investing aggressively, and that Marvell will successfully translate those investments into long-term financial performance. These expectations are no longer just forecasts. They're increasingly reflected in today's valuation. Which raises the question every investor should ask. Are these assumptions achievable? Expectations alone don't create investment returns. Execution does. The market has already outlined an ambitious future for Marvell. Now the question shifts from expectation to capability. Can the company sustain the growth investors are anticipating? Can it expand profitability while scaling its business? Can it strengthen its competitive position as AI infrastructure continues to evolve? Answering those questions requires more than optimism. It requires an objective assessment of the business itself. Because only when a company's fundamentals justify the market's expectations, Can a premium valuation truly be deserved? Not every company benefits equally from the AI investment cycle. Competitive position determines who captures value. Marvell's role isn't to compete with GPU manufacturers. Its role is to solve one of the industry's most critical challenges: moving enormous amounts of data quickly, efficiently, and reliably. As AI clusters become larger, the demand for high-speed networking, optical interconnect, and custom silicon continues to grow. These are precisely the markets where Marvell has built its expertise. The investment thesis, therefore, isn't simply that AI will grow. It's that Marvell occupies a strategically important position within that ecosystem. A strong competitive position creates opportunity. A strong business model turns that opportunity into financial results. Marvell doesn't need to dominate every part of the AI ecosystem. It only needs to be indispensable where it competes. Its business is built around enabling the movement, processing, and connectivity of data across modern AI infrastructure. As customers expand their AI deployments, demand grows not only for computing power, but also for the networking, optical, and custom silicon solutions that connect those systems together. In other words, Marvell's value isn't defined by the size of the AI market. It's defined by the critical role it plays within it. A compelling investment story must ultimately be supported by financial results. Because markets can price expectations, but businesses create value through execution. Over the past several years, Marvell has continued to expand its presence in higher value markets, while improving the overall quality of its revenue mix. As AI infrastructure becomes a larger part of the business, investors are looking beyond revenue growth alone. They're watching for stronger margins, higher free cash flow, and consistent operating leverage. These are the financial signals that determine whether today's expectations are being validated, or simply getting ahead of reality. Strong companies don't operate in isolation. Their long-term success is ultimately shaped by the industries they compete in. While Marvell has demonstrated solid execution, sustaining that performance depends on the structure of the AI infrastructure market itself. Not every layer of the AI ecosystem captures value equally. Some segments benefit from powerful network effects. Others compete primarily on price. Some enjoy high switching costs and durable margins. Others face constant technological disruption. To understand Marvell's long-term opportunity, we first need to understand the industry it operates in. Understanding the industry structure is only the first step. The next question is where Marvell stands within that competitive landscape. Unlike many technology companies, Marvell doesn't compete across the entire AI ecosystem. It competes in a highly specialized segment where performance, reliability, and engineering expertise often matter more than scale alone. NVIDIA dominates AI compute. Broadcom has established a strong position in networking and custom silicon. AMD continues to expand its presence in AI acceleration. Meanwhile, companies such as Synopsys enable chip design, while Microsoft and Palantir operate much higher in the software stack. Marvell occupies a different position. It focuses on the critical infrastructure that enables these systems to communicate, scale, and operate efficiently. In other words, Marvell isn't competing to own the AI ecosystem. It's competing to become indispensable within one of its most important layers. Industry structure explains where value is created. Competition explains who competes for that value. The remaining question is what will expand that opportunity over time. several structural trends continue to support long-term demand for AI infrastructure. AI models are becoming larger and more computationally intensive. Hyperscalers continue investing in next-generation data centers. Network bandwidth requirements are increasing rapidly. And the growing adoption of custom silicon is reshaping how AI infrastructure is designed. Together, these trends don't simply increase demand for computing. They increase demand for the high-speed connectivity that allows AI systems to operate at scale. These are the forces that will ultimately determine the industry's long-term growth trajectory. We've now examined the business, the industry, and the competitive landscape. The next step is to translate that analysis into financial expectations. A financial forecast isn't about predicting the future. It's about quantifying an investment thesis. If AI infrastructure investment continues to expand, and if Marvell maintains its competitive position in networking and custom silicon, revenue growth should remain supported by long-term secular demand. At the same time, a richer product mix and greater operating leverage could continue to strengthen margins and cash generation. Of course, every forecast depends on assumptions. Customer spending, competitive intensity, and execution will ultimately determine the outcome. But based on everything we've analyzed so far, this forecast represents the financial path that best reflects Marvell's long-term investment thesis. Every investment begins with a simple question. What is a reasonable value for the business? Rather than relying on a single valuation estimate, I prefer to evaluate Marvell across a range of values. This framework recognizes that market prices are influenced not only by business fundamentals, but also by changes in investor sentiment. That's why I estimate 3 valuation scenarios: a conservative value, a historical fair value, and an optimistic value. These values are not predictions of where the stock will trade. They simply define a range within which the market has historically been willing to value the business under different conditions. The further the market price falls below that range, the greater the potential return may become, while the downside risk may gradually decline. Conversely, as the market price moves further above fair value, the potential upside becomes more limited, while valuation risk increases. Ultimately, valuation is not about predicting price movements. It's about understanding the relationship between price, value, potential return, and risk. Valuation is only meaningful if it differs from the market's expectations. That naturally leads to the next question. Where could the market be wrong? Markets are remarkably efficient most of the time. But they are not always perfectly accurate. Prices ultimately reflect expectations. And expectations can sometimes become either too optimistic or too pessimistic. In Marvell's case, the market appears to be balancing exceptional long-term AI opportunities against near-term execution risks. The key question is whether today's valuation fully reflects the company's long-term earning power, or whether investors are placing too much weight on short-term uncertainty. There is no certainty that the market is wrong. But if our assumptions about Marvell's competitive position, industry growth, and long-term earnings prove to be correct, then today's market price may not fully reflect the business's intrinsic value. Ultimately, that difference between price and value is where investment opportunities can emerge. Every investment thesis comes with uncertainty. The goal of research is not to eliminate risk, but to understand it before committing capital. For Marvell, several risks deserve close attention. AI infrastructure spending could slow more than expected. Competition may become more intense as large semiconductor companies continue investing aggressively in networking and custom silicon. Customer concentration also remains an important consideration, particularly if hyperscale capital spending becomes more cyclical. And as with any technology company, execution matters. Delays in product development, changing technology standards, or slower customer adoption could all affect future financial performance. None of these risks necessarily invalidate the investment thesis, but they represent the key assumptions investors should continue to monitor. Because successful investing isn't about finding businesses without risk. It's about understanding whether the potential reward adequately compensates for the risks being taken. We've now reached the end of our analysis. Throughout this research, we've examined the market's expectations, the quality of Marvell's business, its competitive position, the structure of the industry, and a valuation framework grounded in long-term fundamentals. The evidence leads to a straightforward conclusion. Marvell appears to be a fundamentally strong business operating in one of the most critical segments of AI infrastructure. Whether that ultimately translates into superior investment returns will depend on two things. First, the company's ability to continue executing against its long-term strategy. And second, the price investors choose to pay for that business. Because even exceptional companies can become disappointing investments when expectations become excessive. And equally, outstanding opportunities often emerge when market prices temporarily diverge from underlying business value. The market will determine Marvell's share price in the short run. But over the long run, business fundamentals remain the ultimate driver of value. Whether Marvell proves to be the AI stock everyone is mispricing, only time will tell. But based on the evidence we've examined today, it is a conclusion that deserves thoughtful consideration rather than a quick opinion. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.